We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Brian Hirschman, managing partner of Hirschman Capital. Thanks for joining me today, Brian.
Hey, Tom, thanks for having me on the show again.
Great to have you back. You recently released your investor letter, and in it, you go into why you think that ultimately inflation should accelerate from here. So why don't we start by kind of digging into why you think inflation is headed up yet?
Sure. Well, the last times I was on the show, we talked about these massive bubbles in global bonds, in US equities, and US real estate. And although we've had a bit of a sell-off in US equities this year, they still have a long way to fall to get back to fair value. And so the fact that these gigantic bubbles have persisted, that tells us that investors almost certainly think the current inflation increase is temporary, because you can't justify these insane valuations unless you think inflation is going to quickly decline. Probably the best example of that is the treasury market, where you have a 2% 10-year treasury, which makes no sense if inflation is going to continue to be 7%. It only starts to make sense if you think inflation is going to decline soon. My view is almost the total opposite of the consensus, because although I do think the labor force issues and supply chain issues are going to improve, government debt is still extremely high, and it isn't going away anytime soon. In fact, US government debt is at levels that have almost always led to default. I did a study where I went and looked at every situation over the past 200 years where government had 130% debt to GDP or higher, which is similar to where the US is. And I found that in 51 out of 52 of those situations, the government defaulted. So that tells us that sooner or later, the US government is going to default through sustained high inflation. When that happens, the bubbles should break, the gold should soar, and I think the gold miners, such as the ones owned by my fund, should go up even more than the gold price. For instance, my fund's gone up around 160% over the last 7 years compared to 50% for the gold price and 35% for the GDXJ.
So, Brian, while we think about all of these factors that are going to keep pushing inflation up, what are some of the factors, like, let's say, supply chains being resolved, that are going to help bring inflation back down? Are those going to have a significant effect to counteract the continuing rising inflation that you're seeing?
Yeah, we could certainly see some benefit from those in the short term. More people will come back into the labor force, supply chains will adjust, but you don't need supply chain pressures and you don't need issues with the labor force in order to have an inflation crisis. If the government has too much debt, people will inevitably realize that, and they'll want to get rid of their dollars, and that will lead to inflation. And that's why so many countries throughout history, Venezuela, Weimar Germany, Turkey recently, they've all had inflation crises that weren't necessarily triggered by supply chain issues. Inflation can be caused by multiple things, and it is possible, I think it's probably likely we'll see a dip in inflation before we see that inevitable surge. So I don't mean to suggest that inflation is going to go straight up from here. I think at some point, government debt matters, and when that happens, we'll get much higher sustained inflation, regardless of what's happening with the supply chain.
Excellent. So many investors think that gold prices are driven by real interest rates. Should we be worried that the Fed is expected to raise interest rates this year?
I don't think investors should be worried about that. I think interest rates have some short-term impact on the gold price, but they aren't the main long-term driver of the gold price. The bigger issue is concerns about the bigger driver of the long-term gold price is concerns about default risk and inflation risk. Gold, of course, unlike bonds and equities, it has no default risk. And also, unlike bonds and equities, gold doesn't have inflation risk because it doesn't depend on payments, cash flows that are far in the future. Hence, when investors become more concerned about default and inflation risk, they tend to shift from bonds and equities to gold, and that causes the gold price to go up. And we can see throughout history that interest rates haven't been the primary driver of the gold price. It's actually been concern about inflation and default. For example, during the 1970s, you had interest rates rising, yet gold did extremely well. And that was almost certainly because investors were becoming increasingly concerned about inflation as the decade progressed. And then in the 1980s and 1990s, you had interest rates falling. But despite that, gold didn't do very well. And that was probably because investors were becoming less concerned about inflation as inflation dropped and also as government finances improved. Then again, during 2003 to 2007, even though interest rates were going up, gold did incredibly well. And that's probably due to its low starting valuation, but also because investors were becoming more concerned about the aggressive government borrowing and aggressive monetary policy that we saw during the years leading up to the global financial crisis. Over the last 14 years, we have had a situation where interest rates have been low and gold has done well, but I think that's more correlation than causation. What's really been going on, in my opinion, is that investors have been very concerned about the potential inflationary consequences of these crazy government debt levels and these unprecedented monetary policy interventions, and that has caused them to want to own more gold. Going forward, I think we'll inevitably get much higher inflation and much higher interest rates, and that will also lead to a much higher gold price. But one thing that's very different now about the past is we have these triple bubbles in bonds, equities, and real estate. And we also have a gigantic bubble in the Chinese real estate market, which is arguably the world's most important asset class due to its size. And we also have record global debt. And so all those things, as Jim Rogers and Jeremy Grantham have warned, could make the next financial crisis much worse than things we've seen in the past. But that should mean that gold could go far higher than it has in other crises, as it has in the past.
So, Brian, when we think about how some analysts say that gold does really well when inflation is increasing, last year we didn't really see gold have that performance. So how do you explain gold's performance over the last year when we did see that rise in inflation like that?
Yeah, I think the big issue is that bond and equity investors, and those are very big asset classes, they're around 350 trillion, they still view inflation as temporary. And in order for the gold price to go much higher, you need investors to shift from those asset classes to gold. Inevitably, those investors are going to realize that the US is going to need to default through sustained inflation. And when that happens, that's when we should see the big surge in the gold price. And based on where gold went to during the last big inflation crisis we had in the US in the 1970s and early 1980s, I think gold could go to more than 6,000. And since the next crisis might be worse than that, it could go even higher.
Interesting. Do you think that within that last year that some of the demand has been taken away from gold and gone into cryptocurrencies?
I think the impact from crypto has probably been limited. For one, it's a much smaller asset class than gold. It was around 2 trillion last year versus gold at more than 10 trillion. And the market cap has gotten smaller lately, of course, because there's been a sell-off, which is something we warned about the last time I was on the show. The other thing is, I think a lot of the investors in cryptocurrencies, they wouldn't otherwise be investing in gold. I think they're more speculators that might be investing in profitless tech companies or cannabis stocks or meme stocks. And so for those reasons, I think there has been some impact on gold from cryptocurrencies, but I don't think it's reduced the gold price by more than 5% or so. So significant, but not dramatic.
So in a way, they're really serving different purposes, right?
Yes, exactly. Gold is something that is the ultimate low risk asset. As we talked about, no default risk, no inflation risk. Whereas cryptocurrencies are something that's frankly worthless, probably, or has very, very little value and is more correlated with risk assets, as we've seen this year. And although the blockchain will almost certainly have value, cryptocurrencies themselves, I'm not really sure what their long-term purpose will be.
Mm-hmm. So when we think about, Brian, let's say the role of the cryptocurrencies for speculators to try and trade in and out of and gain some alpha that way, do you think that the mining stocks, once that sector heats up, will kind of serve the same purpose of serving as a, let's say, a platform or an arena for speculators to come into?
Yeah, I think for the gold miners, it was a tough year last year because you had rising costs and a flattish gold price. But over the long term, I think you'll have a much higher gold price. And certainly for the gold miners in my fund, I'd expect to see much improved mining costs over time as borders reopen and supply chains improve, and other factors should help on the cost side as well. And we're starting to see that rebound this year. I think my fund's outperforming the S&P 500 by more than 1,000 basis points year to date. And we've done a good job of keeping up with the S&P 500 over the last 7 years or so. I think we're only a little behind it as of this month. And as far as when these bubbles ultimately burst, I think the gold miners should go up far more than the gold price. What I've often said in writing is I expect our fund to appreciate more than 500%. The gold miners could go up a lot more than that, but we're value investors, and so we're not going to hold on for the last dollar. You'll get the benefit of the higher gold price, which will, of course, improve margins. You also get a re-rating because the higher gold price will make many of these companies seem less risky and make it easier for them to raise capital. And you will, as you said, probably get a lot of speculative capital flowing into the sector when the inevitable crisis occurs and we get that big increase in the gold price.
Mm-hmm. So, Brian, I'd like to go back to, the interest rate story. You recently wrote that there's a misconception that regulations can keep interest rates low. So can you explain why that is?
Sure. I think all governments, including the US, when they have too much debt, they try to keep rates low by using regulations. And the US has been no exception to that. For instance, as part of the Basel III commercial banking regulations, the US has required its commercial banks to own more government debt in order to comply with these liquidity coverage ratios. And as a result, US commercial banks have gone from lending no money to the Fed in 2008 to now owning around $4 trillion of debt securities in 2021 that have been issued by the Fed. Recall, as we talked a little bit on the last two shows, the Fed hasn't been funding its asset purchases by printing money. It's been issuing floating rate debt that has been purchased by commercial banks. And if it wasn't for these regulations, it would have been a lot more expensive for the Fed to fund its asset purchases with these excess reserves, which are another name for these floating rate debt obligations. Now, another important thing that the US government has done is it changed the rules for money market funds. It used to be that all money market funds were allowed to have a stable $1 price per share. Now, it's only government money market funds that are able to do that. Prime funds, which also own corporate debt, have to have a floating rate price per share. And as a result, prime money market fund assets have collapsed, and government money market fund assets have gone from around 1 trillion in 2015 to around 4 trillion today. And that's been a huge source of demand for the treasury market. And that's been something that's contributed to the bubble lasting as long as it has. Now, if we add up all these regulated entities like the Fed and commercial banks and money market funds, they own around 40% of publicly traded US government debt. But the big problem for the US is that foreigners still own around a third of publicly traded US government debt. And the US government cannot control foreigners with regulations. That means if foreigners wake up from their slumber, wake up from their stupor, and decide that getting a 2% return on a 10-year treasury when inflation is 7% is not a good investment, then they're going to start selling their treasuries. And because there's such a large portion of the market, that'll be more than enough to trigger a crisis and cause the bond market to collapse. We saw the same kind of thing happen with Spain 10 years ago. They also used regulations to encourage their domestic financial institutions to own a lot of their debt, but they also borrowed a lot from foreigners. Thus, when foreigners became concerned about Spain's level of government debt, even though it was lower than what the US currently has, then Spain had a debt crisis and had to get a bailout from the EU. And we've seen throughout history that countries that borrow a lot from foreigners tend to default much sooner. And this is one of the big reasons. that you can't control foreigners with regulations. And that also helps to explain why Japan is the one country out of 52 in my default study that crossed the 130% government debt to GDP threshold and hasn't yet defaulted. It's probably almost certainly because they haven't had to borrow much from foreigners yet.
Mm-hmm. So in your most recent letter, you rebut 4 more arguments for why the US won't have a debt crisis. Do you feel that the Fed is really trapped right now, and that the reasons that you pointed to about, not really being able to bring interest rates back up is the reason for that?
Yeah, I think if you look back at 1979 to 1981, when we had our last inflation crisis, the Fed had to raise interest rates by around 1,000 basis points to curtail inflation. And the Fed was able to do that because government debt was much lower back then. Debt to GDP was around 31% in 1979. The budget deficit was only 2% or so in 1979. Thus, when the Fed hiked interest rates, it caused a significant increase in the government's interest expense, but that didn't blow up the budget deficit because government debt was relatively low. I think by 1983, the budget deficit had increased to around 6%. So significant, but not catastrophic. Today, I think it's very foreseeable that the Fed is going to need to hike interest rates 300 basis points. That would be very small compared to 1979. You even have former Fed governors saying that the Fed might need to hike interest rates 400 basis points. And that would still be, if we hike rates 300 basis points, that would still be a very negative real interest rate, inflation adjusted interest rate compared to history. So it wouldn't be particularly hawkish. The big problem now is that government debt is much higher. It's around 120%. And the budget deficit, even before any large interest rate increases, is expected to be around 7% this year. That means that if we hike rates 300 basis points, it's easily possible that the US government budget deficit will go to 11% or higher, because you'll have higher interest expense, you'll have a slowing economy, you'll have lower tax revenues, you'll have higher welfare spending, not to mention you probably have declining financial markets, and all those things will increase the budget deficit. The problem with that situation is every country since 1991, which is the earliest period we have data, every country since 1991 that has had an 11% budget deficit and 110% government debt to GDP, all 18 of those countries defaulted within 2 years. So that means the Fed could very soon be trapped in a situation where if it raises rates, that causes a default. And if it doesn't, then inflation continues to stay high. And this kind of situation has often occurred in developing economies like Argentina, Brazil, and Venezuela. And it almost always resulted in sustained high inflation. And it seems like the US might be about to join that club.
So, Brian, when we think about what effects that 300 basis point interest rate rise might have on the markets, obviously that could be very bad for the markets. But do you think that that's actually going to really affect and slow down inflation, considering that it is, relatively small rise, as you pointed out?
Yeah, it may not. It may not. I mean, in 1979, we had to raise interest rates 1,000 basis points to curtail inflation. You had Brazil. Of course, it's not the exact same as the US, but they raised interest rates around, I believe, 750 basis points last year, and that still hasn't curtailed inflation. So it may not, but 300 basis points would be enough probably to cause a US default. So either way, looks like we're likely to get much higher inflation at some point.
So another guest on the show recently said that the Fed would be able to use yield curve control to help keep interest rates low the same way it did during World War II. Do you agree with that, Brian?
Yeah, in short, I think that idea is crazy. In World War II, the Fed printed money to buy bonds, which is different from what the Fed has done in recent years, where they've issued debt to commercial banks to buy bonds. And when you print money, as the Fed did during World War II, you get inflation. And sure enough, from 1942 to 1947, we had 7% inflation per year. And I think if that happened today, where we had 7% inflation for 5 years, we would get a severe crisis. We didn't have a crisis during World War II because financial markets were completely different. You had no foreign investors, domestic investors weren't allowed to buy gold because the government had prohibited it, and domestic investors weren't allowed to. It was very difficult to buy foreign investments because there was widespread currency controls and capital controls at the time. On top of that, you had restrictions on buying new houses. You weren't allowed to buy new cars. You weren't even allowed to buy new refrigerators. And some Americans were forced to save. And because there were so few investment options, they were essentially forced to buy treasuries. And that helped keep the financial markets under control. And then after the war, the government was running massive budget surpluses. So they paid down as the military demobilized after the war. And so they were able to pay down their debt relatively easily. Today, the outlook is completely different. We're projected to run budget deficits as far as the eye can see, even if you make very optimistic, rosy assumptions. So it seems crazy to think that the Fed is going to be able to do the same thing that it did during World War II.
So, Brian, I think another piece that kind of comes in here is how demographics can also affect bond yields. So how do you see that playing a role there as well?
Yeah, there's this popular argument that demographics are going to keep interest rates low and prevent a crisis. And usually the way that argument goes is that because the populations are aging, we have a growing number of middle-aged investors that need to save for retirement, and therefore they're going to want to buy more bonds, and that's going to keep interest rates low. On top of that, people are living longer, and therefore, according to the argument, that's going to increase demand for long-term bonds, and that'll keep interest rates low and prevent a crisis. But I think that argument is crazy because middle-aged people aren't required to own treasuries. They can shift to gold, they can shift to foreign investments. And so once they realize how risky treasuries are, then that selling would be more than enough to trigger a crisis. And we saw this in Europe again 10 years ago. You had big middle-aged populations in Iceland and the pigs, which were Portugal, Ireland, Italy, Greece, and Spain. Yet despite that large number of savers, those countries all had debt crises and all needed bailouts.
So as part of the, let's say, the global savings rate, that is going to be kind of a negative on bond yields, you're saying, Brian?
I think there's probably a number of things that have contributed to high global savings. You have demographics, which we talked about. You also have maybe increased inequality has led to more capital in the hands of the wealthy, and the wealthy tend to buy more bonds. So that's probably contributed to current low interest rates. You also might have savings in developing countries, the savings glut, which might be contributing to low interest rates. So all these things that have contributed to low interest rates and an increase in global savings. But the big problem with all these things is that none of these investors, whether it be foreign savers or the wealthy or middle-aged people, none of them are required to own treasuries. They can shift to gold, they can shift to foreign investments. And thus, once these investors realize how obviously risky treasuries are, 2% yield with 7% inflation, with government debt at a level that has always led to default, it doesn't get much worse than that. So all these investors will at some point shift away from US fixed income investments. And that's why this increase in global savings should not prevent the ultimate inevitable government debt crisis.
Mm-hmm. Okay. So you brought up China earlier. Does their real estate bubble look a lot worse off than the US's real estate bubble?
Yeah, I do. I think the US real estate bubble that we mentioned earlier is the worst in US history. Yet China's real estate bubble is so big that it makes the US real estate bubble look small. I think when I wrote a letter about China last summer, I made the point that the price per square foot of apartments in a lot of Chinese cities was the same as in San Francisco, even though San Francisco has 10 times the construction cost and 10 times the per capita income of China. And then on top of that, you have the infrastructure bubble in China. A good example of that is they own around 60%. They have around 60% of the world's high-speed rail, even though their GDP is only 15% of global GDP. And all this infrastructure and real estate spending, it's been funded primarily with debt. Their debt to GDP is around 350%, including government, consumer, and corporate debt. That's probably about 3 times the ratio that caused debt crises in other developing countries. In real estate with infrastructure, that probably accounts for 50% of Chinese GDP. So if those bubble sectors slow down, then that's going to cripple Chinese growth. And China accounted for around 70% of global growth from 2016 to 2020. So if the Chinese economy collapses, then the global economy will probably also have a severe crisis, and that would probably tank the US stock market, and that would in turn cause a US recession and drive up the US government's budget deficit, which would either trigger or exacerbate a US government debt crisis. So that's a very long-winded way of saying if China's real estate bubble bursts and its economy slows, that's going to be incredibly positive for gold because it's going to contribute to a government debt crisis in the developed world.
So when we're hearing a lot about Evergrande and their collapse, is that kind of playing into, like you said, their housing bubble starting to collapse?
Yes, it could be a sign of that. The exact timing of bubbles collapsing is always difficult to predict, but I think that it could also be a canary in the coal mine there. Of course, they don't borrow dramatically from foreigners, and there's a lot of state involvement in the economy, so they may be able to keep things going, but they've borrowed so much and asset prices are so overvalued there, and they have so much excess infrastructure that one way or another, that economy is going to slow substantially.
Excellent, Brian. I think that's a good place to wrap up. Is there anything else you'd like to add before we do, Brian?
No, thank you very much for having me on the show again. This was great.
Absolutely. And of course, you're available at hcapital.llc and on Twitter at hcapitalllc. Anywhere else you'd like to point to, Brian?
No, that's perfect. Thank you.
Excellent. Thanks for your time.
Thanks, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.